We've also got Taimur Baig, who's Chief India Economist at Deutsche Bank, joining us on the show from Singapore. Now, Taimur, I'm not sure you heard what Rajiv Anand said. He spoke about the fact that if the rupee comes under pressure and the RBI is forced to intervene in the currency markets, you will see the domestic liquidity situation worsen from here on. Do you foresee something like that happening, given the global scenario that given the global challenges we face, and the fact that the RBI has itself spoken about the current account deficit becoming an area of concern?
Right. If you look at the combined effect of the CRR cuts and the OMOs that have taken place in the last few months, and take all the liquidity together, then you can get a full netting out of all the liquidity that could have been sucked out of the system because of the RBI's intervention. So from that point of view, I don't necessarily think that the $20 billion or so of dollar sales is the main reason, because that would actually be completely neutralized by the liquidity injection that we have seen so far. I think we've also had election-related spending that has gone out. We have also had probably some slowdown or discontinuity in a lot of government spending. That has also led to some money staying with the government and not staying with the banking system. So I don't think the system as a whole is hugely short of liquidity. It's that the banking system, for various reasons, is not seeing a lot of the liquidity coming in. But as government spending picks up, that'll get taken care of. But the expectation of liquidity becoming in the same level as what it used to be, say, a year and a half ago, that I think is unlikely, because I think for the near term, we will see deficit liquidity persisting. And I don't think the RBI is particularly gravely concerned if LAF net liquidity was in the -800, -900 range. I think it's only when it goes over $1 trillion that the central bank worries.
Sure, but Taimur, if my numbers are right, the OMO operations by the RBI have given the system something like 1,24,700 crores from November last year. The CRR cut, both the cuts together, have given the system back something like 80,000 crores. Despite that, you see deficit today running, I'm going by yesterday's number, I think it was at about 1,24,000 crores. Despite all of that infusion, you're still seeing the deficit run at that level. So my question really was, when the rupee comes under pressure, as everyone believes it will, and the RBI intervenes, should we expect that the situation could get far worse than what we saw the week before last? Could we expect that the deficit in the system could climb to levels of maybe 200,000 crores, maybe 220,000 crores even?
So I suppose if the rupee came under pressure tomorrow, and there is not much government spending taking place, then of course, the LAF could worsen even further, but I'm sure it's not going to be a static game where the RBI just sits around and the LAF goes into worse and worse negative territory. I think the central bank, if it is indeed carrying out intervention, which I don't think it will, I think rupee at 50 is a very comfortable level for the RBI. If it slips by a rupee or two tomorrow, I don't think the RBI will worry. But even if it did, I'm sure there'll be simultaneous OMOs and, if need be, more CRR cuts. The RBI, I don't think it has demonstrated its intent that it doesn't want liquidity to deficit to worsen a much greater degree. Otherwise, it would not have done the 75 basis points in cuts last week.
Right, and Taimur, also a quick word on inflation. For January, we had the monthly number come in at 6.6. Yesterday, we had the February number come in at almost 7%, 6.95%. Going forward, what do you believe the outlook on inflation is for March? What do you believe that number could possibly look like? And how concerned would you be about the ability of the Reserve Bank of India to cut rates going forward simply because of the inflationary risk it faces?
Right. I think that last point that you mentioned is the first thing that I'm going to take on. There is a great deal more additional complication for the RBI now in terms of figuring out what to do with the rate cycle, given that we have emerging upside risk to inflation. There was one part of the RBI statement that really caught my eye, that the three big headwinds to the Indian economy mentioned the same sentence. High oil, high fiscal deficit, and a weak current account. Under those three major problems beginning to manifest further and further, it's very hard for the central bank to give very clear signals about monetary policy easing. And final thought on the inflation's trajectory going forward. if, for political reasons, the government chooses not to pass on fuel prices, we will of course have an adverse fiscal outcome, but we could actually see inflation head down towards 6% by April or May. Even if you assume reasonable increase in food prices and reasonable increase in the core prices, manufactured goods prices, you could still see inflation head below 7 to 6.5 perhaps in April and perhaps even to 6, provided they don't do any fuel price adjustment. That might give the RBI a very small window to do 1 or 2 rate cuts, and then maybe in June, July we see fuel price increases and we are done for the rest of the year. So that could be one scenario. RBI does a couple of rate hikes in the first quarter of the new fiscal year, and that's it.